of course, got crushed today with the Nasdaq down more than 3%. Let's discuss now with Jeremy Siegel. Professor Siegel, great to see you as always. Thanks for joining us. I mean, to start things off, I'm actually going to ask about yields. What do you make in the rise in yields over the course of the last 2 or 3 trading sessions and those minutes from the Fed today?
Well, as you know, Will, I've been saying for over a year the Fed had to be far more aggressive than the market had expected with the inflation, I think, never temporary and going to get worse. And I think the minutes in December reflect a lot of concern of those Fed officials. And I think the market is beginning to say, yeah, they are going to get serious. I heard Steve Leisman say that there's 40% chance of 4 rate hikes. I think a couple weeks ago, I told Sarah there was going to be 8 rate hikes, and everyone jumped. I think they're going to do many more than 4 rate hikes coming up, and I think that fear is now what we see in the 10-year bond.
But here's the problem, Professor Siegel. The Nasdaq fell 3.5% today, and the S&P, got hit pretty hard as well. And how many more of those days can the Fed stomach? In other words, did the Fed miss its window? Inflation looks like it may be peaking. And if we continue to see these financial conditions, then things might tighten fast, not really affording them the opportunity to do rate hikes.
Well, let me comment a little bit. I mean, I love Josh, and I heard you interview him a little bit more, saying, we can't repeat 2018, but we're in a very different situation. We have $4 trillion more of reserves in the bank than we did back then. So when they began to run it off, it was beginning to tighten on the bank. We got $4 trillion. And we also have an inflation problem. Back then we had 0 inflation, inflation below the Fed target. So I remember we are virtually at full employment, in some measures over full employment. And the second important goal of the Fed, and some say the most important goal of the Fed, is controlling prices. So, yeah, there may be a market reaction. I actually think it's a rotation. That's what you're seeing. I still think we could have a good market this year, but certainly those with good cash flows are going to benefit at those that have the discount rates go way out in the future when the Fed is being aggressive. So I don't think it's going to be a bad market. I think it's going to be a rotated market, and I see that's what you've been seeing in the last two or 3 days.
What about, Professor Siegel, those companies that, while they have good cash flows, do have quite rich multiples, like a Microsoft, which was down almost 4% today? I mean, is this the start of something more meaningful in terms of pullbacks for those types of stocks or not?
Well, I think anything with a higher multiple is more vulnerable. Just on the basis of simple financial arithmetic, when you raise the discount rates, the higher the multiple, which means you're discounting further out in the future, means a bigger price drop. And that's the tilt that you're actually experiencing now. And I would not be surprised at all to see that tilt continue throughout this year. Certainly the more conservative stocks, 40 is certainly not 200 times revenues, of which, of course, there are a number of the really high-flying stocks. So those are the more conservative side. They're not going to be hit anywhere near as much as what we see. And, when we take a look at what is down 30, 40, 50%, those are the ones that are going to be hit the most. And I actually think that the value stocks this year will be up. I think even the S&P could be up 10% this year. But I think you're going to see the rotation because of the interest rates.
I was going to ask about the market multiple for the S&P 500. What is it trading at? 20 times next year's earning? That's historically higher than average. And just what type of hit the S&P 500 itself could take in the environment that you envision?
Yeah, and actually it's selling at around 22 times earnings, a little bit more expensive. But look, even if the Fed raises, as I say, to 2%, and the 10-year goes to 2.5 or 3, that is still extremely low. With those low interest rates, you wouldn't expect the market to go back to its 200-year average of a 15 PE when interest rates were much higher than today, and the markets were nowhere near as liquid as today. In fact, I've often said I think the normal range of price earnings ratio is 20 to 22, and we're in that normal range right now.
So overall, Professor Siegel, when you mentioned that we could still have a good day overall, a good year overall for the major indices, do you think that comes by year end as opposed to immediately bouncing this week, next week from these small pullbacks like we kind of seemingly did throughout all of last year? Do you think we will have a 10, 20% pullback in Q1 or Q2?
Well, remember, I think I coined the term last year, the taper tremors. Is whenever you hear that they're going to have to notch up it, you're going to have a day like today. And then people are going to say, yeah, where else am I going to go? I don't want to go into bonds. I don't want to go into cash. I want to go into real assets. So in between times, the market will be supported. The Fed is going to have to tighten again. You'll see the rotation. The tremors are going to come, and they're going to be out through the year. And that's why we're not going to have a 2021 26% gain. But we still certainly could have an 8 to 10% gain with the rotation taking place.
Yeah, all about the value. Jeremy Siegel, Professor, thank you. Good to see you.
Thank you very much.